these are sample questions that some of you have had Professor Falk, right? Patrick Charles Falk, right?
Yes.
Right, so over the years, we worked on some questions. So hopefully you guys find these useful. Who else? Aside from Patrick, anyone else have Professor Falk? CJ, what do you have?
It's a national 2 and advanced 4.
You have fun?
Interesting.
Did he give me a hard time periodically?
Sometimes.
Sometimes the two of us have heavy duty debates about certain things. Okay, having said that, let's talk about the questions and the suggested answers we put together. Briefly, describe and explain why a person would contribute to any of the following trusts below. Okay, and we have a charitable remainder annuity trust, right? Why would we set one of these up?
Where we are?
What's that?
Where we are?
Where are we? Do you have the sample questions and answers?
I only have the answer.
Oh, guys, I had everything laid out up there, so now you got me nervous. Charitable trust.
Income tax deduction.
The ones that check it for? Yeah, it's one.
Yes.
And the suggested answers. Easy, you got it? All right, got me nervous. So that, all right, and by the way, just for next week, everyone has the chapter, not next week, 2 weeks from tonight on IRD, and you have the sample questions and answers, right?
Yes.
All right, just want to make sure. Mom, you got it for next 2 weeks from now? Okay, just want to make sure. Right, so we're back to why would someone set up these kind of trusts? So if they're set up today, you can say to your client, right, you're going to get the current income tax deduction equal to the value of the remainder interest. If it's upon death, okay, someone dies, and they set up a charitable remainder trust, is that they get a estate tax deduction equals to the remainder interest. There's no income tax on these trusts. Remember, it has to be for a non-charitable beneficiary for 20 years or life. Can't be any longer than that. Remainder has to be to a qualified charity. Can't be less than 5% or more than 50%. Can be expressed in a dollar or percentage terms. Okay. Unity trust, same thing, except this time it's got to be a percentage of annual value. And keep in mind, it's percentage of annual value, but also add the assets have to be revalued annually. So a CRUD is not your go-to instrument, right, for hard to value assets. And the quintessential example of that, right, guys, is real estate. Charitable lead trust. Okay, this time we're going to flip it. The charity is the lead, non-charitable is the remainder. It's expressed as a dollar amount or percentage of the initial value. Once again, it can be for life. There's no term limit, right? It could be for however many years you want it. And as we pointed out, it's most often used as a testamentary device. Most often used testamentary. Like I said, I've never seen an inter vivos charitable lead annuity trust or uni trust. Ditto with the question D, charitable lead uni trust, fixed percentage. Pooled income trust, again, the person retains a right for income typically for life, balance to charity. And question F, are there pro forma documents available? There are pro forma documents available for all of these trusts. All of these trusts have pro forma documents available. What are the general requirements? This cannot be an oral trust. It must be in writing. Yes. Can't be for too long. Can't be too little or too much. Can't be less than 5%. Can't be greater than 50%. The remainder interest, this is at the point of creation deal, it's not that 10% of value must be 10% at the point of creation.
Got it.
And finally, as pointed out, and we'll see this again, there's also this 5% probability test that's associated with charitable remainder annuity trust, not uni trust, okay? 5% remainder probability with annuity trust, not uni trust. Why? Because the uni trust is self-adjusting, right? If it gets smaller, the payouts will be smaller. If it gets larger, the payouts will be larger. So there's no, there will be, assuming the 10% test is met, it will always meet the 5% test. That is not true with respect to the charitable remainder annuity trust. It may not meet the 5% probability test. Why were limitations placed in 1969 regarding charitable trusts? Because they were area plagued by taxpayer abuse. Why? Taxpayers they would set up trusts with income interests, and the income interests were readily manipulated. Is there much room for manipulation when you have a fixed annuity amount? Is there much room for manipulation with a fixed uni percentage? And the answer is no. Okay? Not much room for manipulation.
That
Go ahead.
Sorry, that 50% number, that seems absurdly high, right? I mean,
Yeah, you know what was happening is the 50% number, there was, if you Google this, years ago, people were setting up charitable trusts that paid out 70%, some exorbitant, and they were able to manipulate write-offs in a way that Congress thought it was abusive. So they had to curtail these very high percentage payouts.
okay.
Right, so
Yeah, 50% just seems weird.
50% seems high, but believe it or not, there were even higher ones that games were sought to be played. By the way, I'm just going to share this with you. This is Code Section 2702. Does anyone know Code Section 2702? Code Section 2702 pertains to grantor retained annuity trusts. Code Section 2702, taxpayers. Notice I just used, it's GRAT. Everyone recall GRATs are something that the code sanctioned in 1990. Notice there's no remainder. It doesn't talk, excuse me, it doesn't have the word charity in it. It's called a GRAT, where people can set up an annuity trust and there's no charity involved. So Visa could set one up, getting back to you and your children, Visa, you could set up, put $1 million in, retained, it's a grantor retained annuity trust. Visa retains a very high annuity back to herself. So she puts in $1 million and she agrees that over the next 10 years, she's gonna retain an annuity of say $120,000 a year. And if Visa puts $1 million into a trust and retains a right to an annuity for $120,000, what do you think the value of the remainder interest is going to be? David, high or small, high or low? If she puts in $1 million, retains the right to $120,000 fixed for the next 10 years, is the remainder interest going to be large or small, David? Small, right? Everyone agree? In this interest rate environment, unless that trust has a very good rate of return, there may be close to zero, right? And this is called a zeroed out GRAT. And this is, if you Google this, very common in estate planning because people like Visa and very wealthy people like the Waltons, there's a case called Walton v. Commissioner, where a GRAP is premised on the same idea as a CRAP, but in the non-charitable context, where Visa sets this up, retains the right to income for the next 10 years of $120,000, not income, Anthony, right? An annuity amount. Let's get away from the word income. And for gift tax purposes, she can value that gift on her gift tax return at 1 penny because she retains such a robust annuity back to herself.
For the 1 million she put in.
She put in 1 million,
No,
but she
no,
retained the right
okay.
to $120,000. For gift tax purposes, the value of her remainder interest is valued close to zero. And good news for Visa, and this was true for the Waltons, suppose the trust is invested in some closely held business and it really does well. So over the next 10 years, the closely held business grows from, say, $1 million to, say, $3 million. And yes, Visa's gonna get her 1.2 million, right? She's getting, you know, I said $120,000 a year. Everyone agree? Guess what's left in the trust when Visa's done with it? 1.8 million, right? Because the closely held business grew from 1 million to 3 million. Her children now get 1.8 million. Did Visa have to file any subsequent gift tax return? No. Did they just get $1.8 million free of gift tax, guys?
Not too shabby.
Not too shabby, right? So, just so you I'm mentioning this because when the Democrats and Hillary Clinton, there's, you know, what a difference a week makes. And there's talk, well, if Hillary Clinton came to power, one of the things that the Democrats were going to do, they were going to take charitable remainder annuity trusts and say that if Visa made this gift, that there would be a minimum of at least 20% remainder interest, that you couldn't zero out this interest, that no matter what, she put in $1 million, there must be minimally a $200,000 gift in the example I just gave you. I'm just letting you know that, so this area of the law has been transposed or put into the non-charitable context. And if this area of the law remains, meaning 2702, which is a big question mark, at some point you may see rules very similar to what we're seeing tonight. Who knows? All right. I think we left off with question 2B, or 2C. A CRAT or CRUD have more than one non-charitable beneficiary, and the statute permits that. Two persons. May a CRAT or CRUD have more than one charitable beneficiary? And the answer is yes. Okay, there can be more than one charitable beneficiary. Okay. Again, the prototypes emphasize some of the items in what are spelled out in question 3. How often must payments be made from a CRAT or CRUD? Have to be at least annually. Again, all this is derived from Code Section 664, guys. How long can payments be made? 20 years or life, right? In both a CRAT or CRUD. Any limitations on investments? Okay. The trust has to be able to invest in things that get a reasonable rate of return. I've never seen this be an issue. Okay? Never be an issue. And basically, I don't think this is going to trump anyone. No pun intended. Trump anyone. Question 3D. How are payments determined under a CRAT? Again, fixed dollar amount or fixed percentage of the initial value. Initial value. Question 3E. A creates a CRAT in 1993, transferring $100,000 or reserving a fixed payment of $5,000 per year, right? That's 5%. 2 years later, he wants to add another $50,000 to the trust. Get back $7,500. Can he do it, guys? Nope. 2-letter word. Nope. 4-letter word. Nope. All right. Again, crunch you can, cracks you can't. Question F. A creates a CRAD, transfers $100,000 from reserves payment for life for $20,000, whichever is longer. Okay, whichever is longer, with a $15,000 per year payment. He's 55. They will receive the charitable contribution of the remainder. Does this work? Does this work? Does this violate? The answer is no, right? It's 20 years for life. This is okay. Suppose the term was for A's life and then to B for 20 years or his life, whichever is longer. Then to the Red Cross. Is this going to be a problem, guys?
Yes.
Yes.
Yeah, this is going to be a problem. Looked okay on the face if you took a cursory glance, but here the trust can exceed 20 years. Because it's first for A's life, and then 20 years or his life. Okay? Can't do it. This is great. Same as 2, except the annuities for B for his life or 20 years from the date of creation, whichever is shorter. Is this okay? Yeah, this is never going to go beyond 20 years. Suppose it was for longer of 20 years for B's life. Is that okay? This is okay because it doesn't exceed the life or 20 years. And here it says A created a trust for the shorter of 21 years for B's life. And here, because the term exceeds 20 years, right? It sounds like a rule against perpetuities, right? You recall the rule against perpetuity, can't exceed 21 years in the life of being. Well, that's not what this statute says. This one says can't exceed 20 years, not 21 years, right? So this would not work. Question G1. What is the 5% probability test discussed in this revenue ruling 77-374? Must be a 5% probability that charity will receive something.
I'm sorry, what question again?
G1. Question 3G1.
Okay.
And I point out again, this is only in the context of a CRAT, not the context of a CRUT. And when does it arise? It arises that the payment rate is greater than the federal 75/20 rate. The 75/20 rate is published every month. Does it apply to CRUTs? And I already said it does not. Question 4. How are the payments from a CRUT determined? Is there a minimum amount? Once again, same sort of percentages, but each year the amount will vary. May a CRUT be limited to income only? Yes. But, query, may I add, I have never met a charitable remainder unitrust that only pays out the income. That, I think you've got to be off your rocker to set up for a client. It should have a makeup provision, right? Everyone agree? Because if it doesn't have a makeup provision, I'm not, again, sure why you would go down this path.
Unless you're really charitable.
Yep. But if you're really charitable, put more money in, kind of thing, and get more bang for your charitable deduction. Well, just be careful, because no offense to my brethren attorney who does house closings, they too can read stuff on the internet and decide, you know, people in this day and age, can we make an observation? I don't know if you guys are gonna share this with me. People find themselves threatened in what they're doing, what they're trained to do, so that people like dentists now, I know you may come across, they don't just practice dentistry. They're trained to give Botox injections, right? Because that's another way for them to get a little bit more work, right? They're not really that well trained to know the consequences of probably Botox, right? But, so my point is, there's many attorneys out there, gee, the housing market's a little slow, why don't they do CRUT, right? And gee, this CRUT, you know, is going to be invested in a way that doesn't pay. I'll just find something off the internet and it says pay the lesser of. And you're the accountant who your client says to you, oh, can you review this for me? Do you see any problems? You look at it and you do it because you're going to defer to the attorney. You can't be a little pregnant here, meaning if your client's paying you to review it, you can't just say, well, I'm sure whatever he or she did is fine. So just be forewarned, guys. Just look at these carefully. There's a lot of people doing things that don't belong doing what they're doing. That's my experience. May a CRUT have a makeup provision? Well, yes, right? Question 4D. Taxpayer A establishes a CRUT by transferring $100,000, reserves at 5% interest for life. The trust provides a full makeup, right? The trust reports the following, right? And we have 4 years here, the value of the principal and the trust income. Everyone see it? So, under CRUT, you get 5%, right? What's 5% of 100?
5,000.
5,000, you guys are good, right? And the income, right, is below that. So you got to keep a chart, right? The makeup chart, the excess chart, the shortfall chart. Everyone see the $1,000 under the shortfall? How about the next year? There's 130. 5% of that's 6,500. We have a $1,000 shortfall. We have an income of 6,000, right? So we can pay out 6,000, but we're still short, right? $500. So our shortfall is 1,500. Next year, we have 5% of 7,500, but it's been a banner year, great income return of 8,500, right? So that is $1,000 in excess, so we can dip in, right? We can dip in, pay out of our shortfall, leaving $500 in our shortfall chart. Next year we have the value of principal 140. What's 5% of that? 7,000. But we have $12,000 of income. We still have $500 shortfall. So we can pay out we can pay out 7,500, right?
Question?
Yes.
In 2001, where the beneficiary gets the 8,500, how much is that beneficiary taxed on?
You go back and just whatever the aggregate, I'm going to do the numbers. I'm going to assume 8,500 because there should be that much income that, let's just say they're going to get taxed $4,000 the first year.
Mm-hmm.
And they're going to get taxed $6,000 the second year.
Okay.
And by doing my numbers right, they got to be taxed at $8,500 the third year, right? What other number comes to mind, Joe?
I don't know. Hang on. Maybe I read it wrong. So they were required to be paid $7,500.
They were required to be paid $7,500.
They got the 85. So because it was. I don't know.
there's no principal payment here,
Right, okay.
okay?
Even though the 85, no, never mind, sorry, I got it. Because
Good.
the 8,500 was, the trust actually, okay, never mind.
You good?
Yep.
Okay. Question 48. What is income for CRUT purposes? For determining if it's less than, good news, you get back to 643B, something you've seen before, right? 643B, fiduciary accounting income. Question F. A contributed Blackacre with a basis of $100,000 and fair market value of $500,000 to a CRUT. If the CRUT sells Blackacre now for $600,000, and any of the gain be allocated to income. Okay, so we didn't get too much into this, but if you look at question F, the pre-contribution gain must be allocated to principal. This is under the regulation. But in your trust document, this doesn't happen too often. You are at liberty to define income any way you wish, as long as it's once the asset is in the trust, or you can, if you so choose, it's not too often, where you could say, oh, for income, for purposes of defining income, income will include all capital gains. But it can only be those capital gains that once the asset is in the trust itself. It cannot be, it's too easy to manipulate things if you could use the pre-contribution gain. Okay? So don't worry, question F is not one of those that I would ask, okay? I want you guys to get the basics here. Question G. May additions be made to trust corpus of a CRUT? Yes, additions can be made to a CRUT, right? Additions can be made to a CRUT. Question H, what is a flip CRUT? This is similar to a NIM CRUT. If you recall, NIM CRUT is net income makeup CRUT, right? NIM CRUT is the acronym that you can add to your vocabulary. A NIM CRUT is a flip CRUT that pays income for only a certain period and then pays a fixed percentage thereafter. Okay, so suppose the first few years it's going to hold real estate, say 5 years, and then you anticipate it's not going to hold real estate, so you're not worried about the appraisals anymore, and you'll flip it into a regular CRUT. So the first few years, maybe you just pay out the income. And then, again, it's going to be the lesser of the fixed amount or income. And then question H2, it says, what are the requirements? In order to qualify, the governing instrument must provide the flip must occur on a specific date or on the occurrence of a single event which is not discretionary with or within the control of the trustees or any other persons. The flip commences in the year following the event. Once the flip occurs, an existing income makeup provision cannot apply and all deficiencies are erased. Again, this is a slight variation on the NIM CRUT. For my purposes, guys, don't worry about a flip either. So strike from your responses here. Question H, 4H, I'm not going to worry about for our purposes, and 4F. Again, for our purposes, a little bit too complex, not going to come up regularly in your practice. Question 5. Okay, how are CRATs and CRUTs taxed? Generally, these remainder trusts are not taxed, right? Unless they have so-called unrelated business income. Unrelated business income is defined under Code Section 512. You want the most famous example of UBIT income? But you can't wait, okay? So you guys know that most 501c3 organizations don't pay tax, right? By their very nature. NYU used to have one of its investors were was Muller's Spaghetti. And NYU used to operate Muller's Spaghetti. And yes, I know, Del's shaking his hand. And it was a great gig because it could operate the spaghetti company and not pay taxes, right? But other spaghetti companies said, gee, how can we compete? Muller's pays no tax, we pay tax. So in the aftermath of Muller's Spaghetti, Congress said, look, if a charitable organization like NYU is operating a business, even though all the profits inure for charitable goods, right? We still have to treat that as if it were a separate corporate tax-paying entity. And hence, that gave rise to the genesis of charities paying tax under unrelated business income. And there's several code sections, 509, 510, 511, 512, that all deal with this issue of unrelated business income. Why? It all started with your spaghetti. Okay, so next time you have a bowl of spaghetti, you'll know, think UBIT. Good dinner conversation. There's a movie, I'm just trying to think that, I went to this tax meeting. I think I told you, thank you guys for, 2 weeks ago for staying late, and then last week getting out a bit early because I was able to go to this tax conference in Baltimore. It was kind of interesting just to see what people's expectations were about the new Trump administration and where the future of tax is going. All right, back to this. Okay, question 5. How are Kratz and Kratz taxed? Again, they're not taxed unless there's unrelated business income. That's question 5A and 5B. Question 5C. May Kratz or Kratz distribute property in kind to satisfy an annuity or unitrust amount? Absolutely, categorically. Okay, but, why? But it will give rise to gains. Now, they won't be taxed, but as Dill pointed out, or we were talking about, when subsequent distributions are made, those gains may result in more taxable income to the beneficiaries, right? So you can have a Keenan-like gain as a result of satisfying the annuity or the unitrust amount. No immediate tax then. What's the distributee's basis in the property? Fair market value. Everyone see that? Everyone see what?
So who's going to be taxed on it?
Picture, if you will, there's Whiteacre, right? Whiteacre. That has a basis of 100,000, fair market value of 500,000, right? And the trustee of a Kratz has to satisfy and pay you, right, a $500,000 annuity amount because there's 10 million in the trust and it pays out 5%, right? 10 million, 5% is 500,000, right? So it distributes Whiteacre to you, right? Now, how are you taxed on that? You're taxed based on the 4-tiered system, right? And for a moment, I don't know what the trust has in terms of ordinary income, capital gain, tax exempt, or principal, right? I know what it has in principal. Let's say I know it has $10 million, right? But I don't know the other first 3 numbers. But one thing's for sure now. It has 400,000 of capital gains. And that can result, since you just got that distributions out, first ordinary income, that first 500,000 may be just pure ordinary income because the trust has other dividend or other kind of income. But if it has nothing else, at a minimum, you're going to have $400,000 of capital gain. So everyone got that?
So that's the difference between having potentially $400,000 of income versus it being an entire return principal. Theoretically, if it has 0 income.
Right. I mean, if Whiteacre had a basis of 500,000 and we gave it to Zal, and the trust had no other income, Zal would just get Whiteacre and be a happy camper, right? Because if under the 4-tiered system, that would be tier 4.
Got it.
You got it, Tom?
Yeah.
Or private subject to excise taxes similar to private foundations? And the answer is yes, okay? There's a whole bunch of excise taxes that, again, came in the 1969 Act to try to prevent abuse. Don't worry, again, I'm less concerned about those. That's a whole course in and of itself. Question 5A. Suppose A sets up a truck by transferring $100,000 to the trust. 2 years later, he sells Blackacre worth $50,000 to the trust for $5,000. Something fishy, something smells in Denmark. And just so you know, there's all these special rules dealing with so-called self-dealing. What would be more problematic? I'm less troubled by this than if he sold Blackacre for $200,000 when it was only worth $50,000, right? Because then, you know, who's getting less money at the end of the day? The charity, right? So generally, you do not, without getting into deep doo-doo, you do not want your settlor or beneficiaries having any dealings buying or selling assets from the trust, right? Generally, even at fair market value, you can run into issues of self-dealing. So, message to your clients, once they put it in, don't anticipate getting it out. Okay, question 6. What is the tiered system? As we said, the tiered system comes in 4 flavors, right, guys? If you know these 4, if you get this 4 system down, the 4-tiered system, it's not hard. The hardest thing that I've seen students fail to remember, it not only includes current, I said this before, I apologize for my repetition, but sometimes it doesn't register the first go-around, doesn't just include the current year's income, capital gains, or tax-exempt income, right? It's all accumulated from prior years, right? So you've got to keep a running tally to the extent not paid out. Question B, 6B. The crowd has $3,000 of ordinary income for the year, an accumulated ordinary income of $15,000. It is required to pay $5,000 to Pete. The crowd has short-term capital gains of $4,000 per year. What is the character of the income to Pete that is distributed? Has to pay $5,000 to Pete. That's $4,000 of capital gains. But what rules the day here, CJ? Why is the answer what the answer is? 6B.
Has to do with the tier system. 4.
I'm the client, so just help me out here.
Isn't the first tier ordinary income?
Okay, so why is it, why don't you just tell me, could your answer be here, 3,000 of ordinary and 2,000 of short-term capital gain?
We have accumulated ordinary income of 15,000.
So your answer is what and why?
So it's ordinary, right? 5,000.
Joey, is that right?
Yes,
And why is that, Joey?
because you're using your accumulated.
Okay, CJ, just wanted you to say, you're not only looking at the current, you're looking at the accumulated, right? I'm the client, you gotta spell these things out. Everybody great? All right. Question 6C. Suppose it be there was $1,000 of accumulated, 2,000 in short-term capital gain, and 2,000 in long-term capital gain. In this case,
This is on top of the 3,000 ordinary income, or
get-
that's it?
yeah. When you say that's it, I mean, we can back into, I put these answers together a long time ago, but if you look at the answer on the top of page 10, is we're going to take, the ordinary income of this year, 3,000, the accumulated income of $1,000, right? And whatever inflicts the most pain, right? That's the system. What's going to inflict the most pain? Short-term capital gain, right? That's how the tier system works. Some people say it's not the tiered system, it's the torture system. CJ, you look surprised. You got that? Because I pointed out that footnote in the text, right? Just to remind people, I brought that upstairs when I was making a Xerox copy for Muhammad, but I pointed out that footnote that said, whatever causes the most pain to taxpayers is the appropriate way of handling the tiered system. All right. Question D, 6D. The CRAB has the following results. Okay. Ordinary income, short-term capital gain, long-term capital gain. CRAB's required to distribute $10,000 per year to a non-charitable beneficiary. Describe how A will be taxed on the amounts distributed to him in each year. Okay? So it's got to get $10,000. Everyone agree? And we got to cause, no offense to him, the most pain that we can. Agreed? Agreed.
Yes.
So how do we do it? We have $10,000, 1997, 8,000 ordinary, 2,000 in short-term capital gain, right? Everyone agree? And what does that leave in terms of excess? For the short-term capital gain, 4,000, long-term capital gain of 3,000. Let me pause there. Does everyone see that? Because if you don't see that, you ain't going to see the rest. Mohammed, you see that?
Yes.
Adrian, you got that? Everyone's got that? Rashida, you got that? Okay, let's look at 1998. We're going to dip into ordinary income first, and then we're going to dip into short-term capital gain. But keep in mind, there's a long-term capital gain loss, right? So the short-term capital gain is how much? It's really 3,000, right? Everyone agree? But we have 3,000. But okay, so we agree that that number in 1998 is 3,000, and we have 4,000 from the prior year. That leaves that together is 7,000, right? Everyone agree that that's 7,000 that we can utilize. We're going to use 4 of the 7, so it really should read 3,000, not 6,000. Everyone agree? And then in the year 1999, we have 7,000 of ordinary. And what do we have in terms of short term and long term? We don't have any more we have 3,000 a short term. Oh no, just doing my own numbers here. Oh, this probably got messed up because there is no more short term. If you're using my number, right, of 3,000, not 6,000, there's not going to be in the answer in question D. There's not going to be any short-term capital gain. Everyone agree? The answer you have that shows 1999, 7,000, 1,000, and 2,000. Agreed? But if you use my number, where the short-term capital gain should be not 6,000, but rather 3,000, okay, that means that there is no short-term capital gain in 1999, and the long-term capital gain. Let me just make sure I don't mislead you here.
We don't net the current year stuff in 1999 also? You get negative 2,000?
I mean, let me just think about this. You know what? That's how I want to, you know what, Dill? Thank you. Let's net it, okay? So we have 2,000 of short-term capital gain, okay? That will leave 1,000 short-term capital gain in 1999. But do we have $2,000 left of long-term capital gain? Is it still being carried forward from 1997? Yes, right? Yes. And that would leave $1,000. Everyone see that? And we're carrying the 3,000 of 1997 forward, and we're going to use 2,000 of it in 1999, so it's going to be $2,000. Everyone see that? We're going to use 2,000 of that, and that will leave 1,000 for next year.
What do you do with 1998?
1998, there was none. There was no long-term capital gain. CJ, you look confused.
So question, the short-term capital gain excess, right,
Just tell me what year you're referring to.
for 1998 is 3,000, right?
Yeah, it's 3,000, not 6.
So the total is it 7,000? The total in net, I guess?
No. But then in 1999, there's a $2,000 short-term capital gain, right, when you do the netting. And that would mean that there's only 1,000 available, right? Look at these numbers after class.
Because why would there be only 1,000 or why is it not 2,000?
Because we have short-term capital gain left of 2,000, right? If you just look at the numbers in 1999, without the excess, 2,000 of short-term capital loss. Do you agree or not? I just took negative 5,000 plus 3,000.
Right.
So we have negative 2,000.
Right.
And our excess is 3,000, right? So we have a 2,000 loss, short-term capital loss, and 3,000 excess short-term capital gain. Put them together and that leaves 1,000. Think about it, CJ. You don't look happy, but look at it. Work at the numbers. I get, at least in my world, I'm a morning person, so anytime 8 o'clock roll, you can invoke it. Better to ask me these questions at 6 or even 5 in the morning are a good time to hit me with these questions.
So in 99 is 7,000 ordinary, 1,000 short term, 2,000 long term.
Yep.
We're not using the 4,000 short-term capital gain from 1997, the excess amount.
We already burned through that.
Then we have a 7,000 short-term capital gain in 1998.
The short-term capital gain in 1998, there was only 3,000 once you netted.
Then what of the long-term capital gain, 3,000, can that be netted against the short-term capital gain in 1998 to come up with the 6,000?
I'm not sure what you mean by come up with 6,000.
Because there's a 3,000 long-term capital gain in 1997.
Right, we're gonna let that lie fallow.
Okay, and then there's a 4,000 loss, long-term capital loss in 1998. If you net that, it's a negative 1,000.
No, we're not gonna net that though. we're gonna net that against the short-term capital gain for that year. You see what I'm saying? We're not gonna net with the accumulated. Each year you've got to look at itself before you dip into the accumulated. Question 8. In the year required to be distributed, one second. Question 8. Assume that the trust is a calendar year taxpayer. Distributions are made $6,000 in July, and they were a little delinquent, and they made $8,000 distribution in February. Okay. How much is Pete going to be taxed on? He's going to be taxed in the year it's required to be distributed. Even if it's dilatory, he has to include $10,000 of income in the current year. Okay? He had a right to it. He should have demanded it. It's sort of like the Mellencrot Trust, right? If you have a right to income and you don't collect it, you have a constructive receipt, right? You will not. I know you're going to be disappointed in this. I will not hold anyone accountable for any estate and gift tax issues. Okay, so notwithstanding question 7C, don't worry about the estate and gift tax issues. Someone actually came up with it yesterday, I forget, Monday night, my Monday night class, they said, oh, I really want to take a course in trust and estates tax. And I said, oh, you really do? Because there, I have to tell you with trepidation, if you took, or we're taking a course in trust and estates law, tax, I don't know if it's going to be around much longer, truly. So this course, I can tell you, the material will be around for a long time. But be hesitant if you say, gee, I want to take an elective in the spring on gift and estate tax. New Jersey, bear in mind, beginning in 2018, has eliminated its estate tax. And the federal government doesn't look like it's too far behind, guys. Question 7B, consequences of transferring encumbered property. This gets back to Crane v. Commissioner, right? If you transfer encumbered property to a charitable trust and the debt exceeds your basis, guess what? Anyone going to be surprised to know it's a recognition event, right? Tufts, remember the Tufts decision? That's the Tufts decision, right? Tufts follows in the aftermath of the Crane decision. So notice too how these questions are orchestrated. 7/8 of them deal with, or 7/9 of them deal with charitable remainder trusts. And there's a reason for that, because those are the trusts that come up in practice. 1/9 deal with charitable lead trust, because in your practice, guys, 1/9, maybe less, will deal with lead trust, and 1/9 or maybe less will deal with pooled income funds. So just bear that in mind as you're reviewing the material. What does the charitable lead trust get? The exact flip, right? The exact flip of a remainder trust. When are CLTs used most, guys? A debt, right? Not during life. Not during the life. C and D, 8C I should say, or permissible charitable beneficiaries. Those are defined under Code Section 170 and in the estate and gift tax realm 2055 and 2522. Who are permissible beneficiaries? Anyone goes. Anyone with a pulse. No pets, please. Okay? I'm not kidding. Lots of people will ask you, can I set up a charitable remainder trust for my dog? No, you cannot. I routinely get those questions. Question 8D. In the CLUT, is there a maximum number of years? You? No, 4-letter word again. Must be for a fixed term of years or life for life, but it can be for however long you wish. Is there a minimum payout? No minimum payout. So very different, right? In texture and feel. Not surprising, the difference between a CLAT and a CLUT. One is a fixed dollar amount, one is a fixed percentage. And a CLUT be an income only, like a NIMCRUT, NIMCLUT. No NIMCLUTs. Okay, guys, no NIMCLUTs. Cannot have the equivalent. There's not that symmetry. Is there a current income tax deduction? Yes. Okay. Is a CLUT a taxable entity? A grantor trust is taxable to the grantor. A non-grantor CLUT is taxable as a complex trust. Okay, again, not too many people I know want to set up a charitable lead trust in the form of a grantor trust because of the adverse tax consequences. So you're not going to see that too often. During the period that a non-grantor CLT trust is paying income to the charitable beneficiary, how is the trust taxed? Let's repeat that. During the period that a non-grantor, not a grantor trust, is paying income to the charitable beneficiary, generally you're going to get a full deduction. So just so you know, most times a charitable lead trust, if it's not a grantor trust, is not paying tax because everything's going to the charity. It's all for the years involved, it's going to the charity. After the charity is no longer a beneficiary, that's when the normal subchapter J rules apply. Question 8 there. Roger creates during his life a 10-year CLAT and is permitted current income tax deduction. In year 1 through 5, Roger includes the CLAT income in his gross income. In year 6, well, you know, this is such an obscure question because, again, no one I know sets these up. Let's get questions 8 and 9. I'm not going to worry about it. The only question I'll finish in question 8 with are there prescribed forms for CLTs and CRTs? And the answer is, it used to say no, now the answer is yes, right? Everyone agree that there are prescribed forms for these forms of trust? Agreed? Yes. Would I print them up for you? No. Why? Because it's a waste of paper, because you're probably not going to see too many of these. Okay? Finally, question 9. What makes a pooled income fund attractive? Well, I'll tell you why it's attractive. It doesn't cost anything in terms of legal fees or administrative fees, right? The charity sets these up, says, please contribute money to us. If you do, we'll give you an income stream for your life. And isn't that nice? And you can get a charitable deduction equal to the remainder interest, and that's it. No fees. Charitable or pooled income fund doesn't have the latitude of a charitable remainder trust. People feel like they have more control with charitable remainder trust than they do with pooled income funds. Usually they name themselves as trustees of the charitable remainder trust. How long must a pooled income fund last? It's for the life of the person. There's no term interest there. How is the pooled income fund portion? Based on return. You get a unit of participation. Who maintains the pooled income fund? The charity itself. How do you determine the charitable contribution? Again, it's based on the remainder interest, guys. If someone transfers property to a pooled income fund maintained by Rutgers, he receives a life interest, or he reserves a life interest for his child, say his 20-year-old child. How is this treated? He's made a gift to his child, right? Of the actuarial value of the income interest, and he gets a charitable deduction for the remainder, right? It's a bifurcated interest. whose life is used? The son's life, right? Because it's for a term for the son. So here's some takeaways, and then let me just give me 5 minutes to talk about next week's class, okay? Not next, I keep saying next week, 2 weeks, okay? Just bear in mind, guys, you should, for exam purposes, have a general idea, in particular, what are the salient features of these trusts, right? How are they taxed? What are the, 4 tiers of torture to your clients, right? That's what I'm looking for. Nothing too complicated at all, to the contrary. Really simple stuff. I just want you, during the course of your tax career, to be able to identify what are charitable trusts, remainder trusts. I also want you to know what is a charitable lead trust, how they differ, okay? Because even though I think you will not come across too many of them, I think you have to be in a position to articulate to your client what their options are and explain the pros and cons, right? Let the client make the decision. You can't look at your client and say, go on the internet to figure that out. You have to be the one to tell them, the general parameters. In practice, again, don't just defer to the attorney and think he or she nailed it. Cross-check it. Now, in terms of class, 2 weeks from now, let me just advise you. If you could, read the handout. Again, what is it, guys? I didn't bring it with me. Chapter 15, is it? Or the other chapter? Chapter 3? Chapter 3? Okay, chapter 3, everyone has. It's longer than the chapter we looked at. I think, by the way, I think this is a good exercise what we did tonight, because I think the reading material is right on point, right? It was only 15, 20 pages. It wasn't, the authors of that book, didn't mince too much words. Similarly, I think, again, I'm using a new book that I Xerox the chapters. I think this is a good book. It doesn't go far afield. Let's just remind ourselves, guys, what is this quintessential IRD item, just so that everyone understands what is IRD. The quintessential form is an IRA, right? Someone dies and they own $1 million in an IRA, right? And the IRA starts paying out to, say, the decedent's daughter. She gets that income. It's never been taxed before, all right? She has to report it under Code Section 691, right? Income with respect to decedent. And there's a whole bunch of issues that surround who's the right party, how much should they get. And there's this Code Section 691C that deals with deduction with respect to any estate taxes paid on it. All these sort of issues. Charitable remainder trust, I'm going to make up a percentage, comes up in someone's practice, in my opinion, maybe 3-4% of your practice. Maybe not, but you should know that. IRD items routinely come up, okay? Routinely. So it behooves you to spend some real time going through that analysis. Let me remind people again, the exam is 3 weeks from today, right, guys? Am I got that right? So please, even though we do have 2 weeks until our next class, don't just put this on hold. I will be around for those who came in late. If you do have any questions, now's the time. Hit me, get it right. Make sure you really have good mastery of the material. Everyone, you're instructed to have a great Thanksgiving too. All right? So I'll see you in 2 weeks.